Hello, everyone, and welcome back to my channel. So, today I will explore whether one should buy AGNC stock after its latest earnings, given that it's known for its 14% dividend. So, have you ever seen a stock paying a dividend yield of nearly 14% and wondered what's the catch? That's exactly the question investors are asking about AGNC Investment Corporation after its latest earnings report. So today I'm going to answer one simple question. Should you buy an AGNC stock right now or not? And obviously, this is not a financial advice disclaimer. It's just for educational entertainment purposes. So let's dive in. First, let's understand what AGNC actually does. So unlike traditional REITs that own apartments, shopping centers, or office buildings, AGNC is a mortgage REIT. So instead of collecting rent, it buys mortgage backed securities, primarily government backed agency mortgages from Fannie Mae, Freddie Mac, and Ginnie Mae. It earns money from difference between interest it receives on those mortgages and the cost of borrowing money to buy them. So this difference is called the net interest spread, and it's one of the most important numbers investors should watch. So now let's look at the latest earnings. The good news is that AGNC's net interest spread has started improving. After declining throughout much of 2025, it rebounded to just over 2% in the latest quarter as older, lower yielding mortgage investments rolled off the balance sheet. That's encouraging because wider spreads generally translate into basically stronger earnings and better dividend coverage. So analysts also expect earnings to improve modestly during 2026, with projected earnings comfortably covering the current annual dividend. And from a cash flow perspective, the dividend appears reasonably well supported for now. But here's what investors need to be careful and be cautious. Agency has a long history of cutting its dividends. The current monthly dividend has remained unchanged since 2020, which is positive. However, before that, management reduced the payout multiple times in 2015, 2016, and again in 2019. But why? Because mortgage REIT earnings depend heavily on interest rates. So when borrowing costs rise or mortgage spreads narrow, profits can shrink quickly. That's very different from owning a company with steadily growing earnings. So in other words, today's dividends may be safe, but it isn't guaranteed. History shows AGNC will cut the dividend if earnings weaken. So another thing investors should understand is that AGNC isn't really a growth stock. Over the past decade, the share price has generally trended lower. While investors who reinvested dividends earned respectable total returns, those relying solely on dividend income saw both their income potential and capital value decline over time. That's an important distinction. So if you're buying AGNC for long-term capital appreciation, history suggests there are better options. If you're buying it for high current income, then it becomes much more interesting. So, who should consider buying AGNC? I think there are three type of investors. First, income investors who understand the risks and want a very high monthly dividend. Second, investors who believe interest rates will gradually stabilize or decline since that environment generally benefits mortgage REITs. And third, diversified investors who keep AGNC as only a small portion of an income portfolio. So, on the other hand, if you're looking for reliable dividend growth or long term wealth creation through capital gains, AGNC probably isn't your best choice. So, here's my verdict. I would rate it a hold or moderate buy, but only for investors specifically seeking high income. The latest earnings suggest that dividend is currently well covered and improving interest spreads are a positive sign. However, agency remains highly sensitive to interest rates, and its history of dividend cut means this isn't a buy it and forget it stock. So if you're comfortable with that risk, the nearly 14% yield could be attractive. And if you're looking for dependable long-term dividend growth, I'd lean toward higher quality REIT or dividend companies with a stronger record of increasing payouts over time. Let me know down in the comments what you think.